Hello, everyone. Today on the Final Bar, we'll do our normal Friday routine, wrapping the week, looking from last Friday to this Friday, how things have evolved. We've had plenty of potential catalysts this week with a heavy earnings week, a lot of the FANG stocks reporting along with many others. Also the Fed meeting, rising rates. We've got all sorts of movements happening. At the end of the week, though, distributive as opposed to accumulative, right? Seeing distribution in the market today with the S&P selling off to a bit of a low for the last couple of days. What does that mean for the big picture? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining me every weekday after the close as we look at these markets together, focusing on the message of price action. Had a couple conversations this week, guys like Larry McMillan, Joe Duarte, reminds me of conversations with Ralph Acampora from years ago, where he said, when all else fails, focus on price. Focus on the message of the markets, right? Price will tell you in a lot of ways everything you need to know, and all the rest, when it comes down to it, is just noise. It's all about price and what's happening, what's working, what isn't. And through much of my career, I've been mentored by people who have reminded me of the importance of focusing on price. You know, as we see that, if you measure things in terms of price, the S&P is making new all-time highs. That seems constructive to me. When you look at breadth, it seems constructive as well. Overall, strong breadth readings. Sentiment is where it gets a little bit hairy. Also, what I call confirmation. We're going to look at a chart of the S&P and look at the bearish momentum divergence I think we're having right now. More of that to come. Wanted to check out the guests we have coming up next week. This week, we had a couple really good guests, and I really like Joe Duarte's comments on Wednesday's show, talking about things like copper and lumber prices. Next week on Tuesday the 4th, we have Jeff Weiss from Clearview Trading Advisors. On Wednesday the 5th, Sean McLaughlin from All-Star Charts. He's an options expert. On Thursday, May 6th, Xenia Taubina from XT Financial Services. Xenia is a short-term trader focused on Elliott Wave, so a very different toolkit than my own. We go a whole three very different guests there. We're starting with Jeff Weiss, who's one of my early mentors in the industry and taught me a lot about the importance about remaining patient, focusing on long-term weekly and monthly charts. I'm sure he'll bring some really interesting ones along with him. Also, as a reminder, coming up next Tuesday, May 4th, I'm doing a special webcast called Sell in May, 5 charts you need to review. Starting Monday, we are now in the seasonally weakest part of the year, May through October. We're going to look at some of the statistics on that, but focus on the message of the markets right now and what it means for this year, and some of the chances or potential probabilities of further upside or downside given price breadth and sentiment readings. If you're interested, go to marketmisbehavior.com/sell in May. I would love to have you join me there. I want to continue on with our Wrap the Week segment. And we'll start with our poll. Recently, we asked you which sector performs the best between now and June 30th of this year. So about 2 months away from where we're at today. And I gave you 4 choices: energy, financials, technology, consumer discretionary. The top vote getter was technology, followed very closely by energy, which is a really interesting dichotomy there. An interesting, 2 very different sectors there getting the 2 votes. Technology, obviously, you've had some big, gains this week from charts like, Alphabet, for example, going higher, and Facebook and others I know are not technically in technology. You think of them as still in that technology space, but energy gets almost the same amount of votes, and that is very much a cyclical leadership sort of sector. And those are stocks that have pulled back a good amount and down pretty good today, by the way. But some of those charts could be setting up, which is this nice pullback before resumption of the uptrend. It's all about whether they're able to hold key support. I'm always interested in what got very little love. And what's interesting is it's the one that I would have voted for, which is financials. If I had to look at the 4 sectors and tell you which one I thought was the best, I'd probably pick financials. And that's a play on higher rates. That's a play on charts like WFC and regional banks and others looking pretty decent. And even the larger names, things like Goldman and JP Morgan holding up pretty well. So we'll see what sectors do well in the next 2 months. But an interesting overall, the weight of the The crowd says technology, then energy. Let's continue on with our Wrap the Week segment. And we're going to go to our chart we usually start with, which is our basically 1 week chart. This starts the clock last Friday at the close. We're looking at just the 5-day returns, percent returns on each of these asset classes. I don't have them labeled, so I'll just point out, follow along with the mouse. You can see what's what. The S&P essentially finished the week flat. Yesterday was a nice move to new all-time highs, new all-time intraday highs, but then came back down. And with the give back today, worth noting, we're still up on the week, but only by a little bit, 0.1%. What outperformed stocks this week? Not much. The dollar was up 0.5%, and that's much of that came today, right? The UUP jumped higher today, and the dollar overall has been relatively weak for the last 4 to 6 weeks. You're seeing a bounce higher in there. We're going to look at a chart of China a little later in today's show. Others, given having some weaker charts in the Asian region, but stronger dollar this week. What really outperformed was crude oil, which is here in brown, up about 2% for the week. Everything else essentially underperformed the S&P. Gold, small cap stocks, and the NASDAQ 100 are all in that cluster right around down 0.4% for the week. Below that, we have in sort of this deep red color, bond prices down 1%. That's using the TLT, and then emerging markets down the most, 1.2%. As I mentioned, the charts of like China and others relatively weak. And again, the bounce in the dollar today certainly not helping the relative value on some of those charts. I did not include Bitcoin on this one. And if you add it, as you probably can guess from anything you followed with Bitcoin, a nice bounce higher today, but finishing the week as of now up around 10.5%. And again, if you think about the relative volatility of some of these data series, usually we have this cluster, and then Bitcoin is usually a barbell. It's way above or way below, and that's just the nature of cryptocurrencies, much more volatility, but overall decent uptrends. And I think the challenge with cryptocurrencies right now, it's the challenge with the momentum trading in general. In general, you tend to have good long-term returns. It tends to be a good strategy to follow, but you better be ready mentally and financially ready for decent givebacks, right? If you're buying Bitcoin at 1,000 and riding it to where it is now, you've had some huge down pullbacks, some huge drawdowns during that period. And again, the problem for a lot of people is that's not it's not a scenario, it's not an environment that's super comfortable for your portfolio, and especially if you're a client's portfolio, to have those sort of drawdowns. So it's all a question of allocation and how much you can stomach, to be honest with you. We'll continue our Wrap the Week segment using the Mindful Investor Live chart list. This is a chart list that I keep updated. You are all welcome to access it. If you've not seen it before, here's how you get to it. Go to your dashboard. At the top, you're going to see a link for articles. This is the homepage for all of the great content from our contributors. If you click on all StockCharts blogs, you'll find mine, which is called The Mindful Investor. And at the very top, you'll see this little button that says Live Chart List. It's going to give you this chart list we're about to review. And again, you're welcome to take those charts, save them, do whatever you like with them. Chart number one is the market trend model that we keep updated. This is using weekly data. It's something I've followed for years, and it's essentially a way of tracking overall market trend. When the S&P is making new all-time highs again this week, I am not surprised and completely understand when the long-term, medium-term, short-term trends are all bullish. They're all in the green. They remain that way. The first signal would most likely be a sell signal from the short term, the tactical read. That would need to close below the 5-week exponential moving average. We did not even touch it this week. And so overall, it's remaining very strong. This model has been completely strong since the end of March. Most of the model has been, for the most part, bullish since last June of 2020, although the medium-term model, which is really the main way that I think about from a stock picking perspective, overall has had a couple sell signals. One in that October period of 2020, which made sense. The second one was sort of February to March of this year. And this is when we had a lot of bearish divergences. Certainly was seeing plenty of signals of increased likelihood of a downturn. We didn't have it. We saw stocks continue higher. As we look at a chart of the S&P, you can see what concerns me right now, and I'll actually annotate this chart live for all of us here. So if we're looking at this, and this gets to one of the questions from the mailbag today, one of my concerns here is you're looking at a potential bearish divergence where the S&P made new highs in mid-April on an overbought condition. That's actually pretty healthy for a good uptrend. However, look at what happened this week. You made a new all-time high yet again, but on much lower momentum. We actually did not make the overbought region. So the challenge I have with that is it's indicating a market rallying on weakening momentum. That overall, the playbook there means to be ready for some sort of pullback, to start looking at swing lows and look for breakdowns. The reason why we look for a swing low is because it does not always play out. If you look here, January to February, you have the same thing. You had the S&P going higher. You had a downturn. Now, granted, we weren't overbought necessarily. Maybe this is a better parallel for that here in mid-January, where you had higher highs in the price, lower peaks in the momentum. If you look, as we continued higher, we kept getting lower and lower momentum reads. The kicker is looking for a breakdown, looking for a price step breakdown, breaking down through the 50-day. That's what we've not gotten on some of these previous things. So the first things first, until we break a swing low, the trend is still up by definition. 4120 is the low from mid-April. That's the level I would look for if the weakness today continues next week, which I think it could. I would certainly be looking at 4120. A break there, you'll start hearing me talk about 4,000, which is trend line support, and the 50-day moving average. We hold that, and overall, I think you can make an argument that the trend is still healthy. We break that level, that S&P 4,000 level, you'll hear me get a lot less constructive and a lot more questioning of further upside. Cumulative advanced decline lines overall are a measure of market participation, a measure of market breadth overall. Long story short, they are very positive. The only one that's really not confirmed new highs, you can see all of these have moved to strong new highs. The common stock only AD line, the advanced decline line for the S&P, the mid-cap index, all have made new highs from mid-March. The one that has not yet is the small cap index. We just barely may have touched it this week again, but really not breaking much higher of it. So that's the one that's not really confirming. And it speaks to how this recent move has been less about small caps and more about sort of the large cap growth trade that's sort of caught up and done well. We'll see if we're at a pausing point in that trend. What we have seen, which is a bullish signal, is an expansion in new highs. These blue arrows show you how, as the S&P has gone higher over the last month, you've seen more and more stocks making new 52-week highs. On Thursday, by the way, it was about 26% of the S&P making a new high. That's a decent number. It's one of the higher numbers you will see around there. And overall, that speaks to broad participation. And again, when I ran a screen earlier this week for stocks making new 3-week highs, I had 150 stocks traded in the U.S. with a market cap above 10 billion. That's not bad. That's not a bad list of stocks to review making new highs. I had 5 making a new 3-month low, so it's certainly much more weight into the new highs list. You know, this is an interesting one. This is sort of a debatable one. I've heard people make the arguments on both sides. This is the percent of stocks above their 200-day, which is around 95% of the S&P as of Thursday's close. And again, 88% of stocks in the S&P are above their 50-day. Overall, those are constructive numbers. Those are bull market numbers. And you can see it's similar to sort of the extended bull market phases. You've seen that sort of run. Where you need to be concerned, or where you need to start questioning things, is where you get a divergence. The S&P going higher, but these breadth lines going downwards. That was one of the things that caught our eye here in January to February, caused us to be a little more cautious. Same thing back here at the beginning of 2020, where you saw the S&P going higher and the breadth lines start to slope downwards. We really haven't had that yet. So you're really not getting a lot of breadth divergences. You are seeing some momentum divergences, but not in terms of breadth. You're still seeing a broad advance. A lot of stocks still making new highs this week. Where we are seeing a lightening up of sorts is with sentiment. We talked about this yesterday, so I don't want to beat the discussion too much. But if you missed it, go back to yesterday's show on StockCharts TV on demand. You can see what I was saying. I went through this along with the VIX and the put call ratios and others. But overall, the percent of bulls has come down in the AAII survey. That's actually an interesting pattern that's in line with previous tops, but you really want to look to see if price itself breaks down. The name exposure index is leveraged long yet again above 100%, which I would characterize as elevated. And the RIDEX flows are at the most bullish positioning in history, which what this combined tells me, looking at the chart, is essentially that the anecdotal buying has been done, right? The buyers are in, people have made the trade. Who's left to push the price higher? That's the challenge when the readings are that high on those positioning surveys. Finishing up our weekly wrap, we'll focus on some of the key ratios. One of my guests this week, I think it was Todd Sohn, was talking about consumer staples and the underperformance there. One of the things we talked about was looking at an equal weighted consumer discretionary versus consumer staples index. That's part of my chart list that we look at every Friday, and you can see that this week it made a new swing high. So what that tells you is it's not just Amazon having a good quarter, which has certainly helped the stock today, even though it actually looks like it finished flat for the week or for the day today. But overall, this tells you basically more the average consumer discretionary stock is doing better than the average staple stock. Investors are still on offense. Areas of concern are a non-zero number, and I think the relative weakness of semiconductors is certainly an interesting pattern to be looking for. The SMH is not going down a lot. It's just not going up anymore. You're finding semiconductors, some of the big stocks like Apple and others are actually hitting resistance and not going up anymore. They're not really breaking down. They've just stalled. The uptrend has stalled. And the question is it wait and see mode? Are we digesting, or do we start breaking down? I think the relative strength of semiconductors getting a little bit lower than this starts to look pretty distributive and tells you a bellwether group is starting to struggle. We've seen small caps do pretty well here in the last couple days, but start to pull back a little bit today. Overall, you can see that small caps did really well, and there's more of a weighting in financials. So the financial sector doing well certainly indicates or suggests strength in small caps. That's been given back mid-March to mid-April, starting to bounce up a little bit. And if we see financials start to outperform, as I suspect they might, we most likely will see that small cap ratio turn a little bit higher. We need to take a quick commercial break. We'll be back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close for our show. As a reminder, we do a mailbag segment twice a week. We're going to answer some viewer questions here in a moment, but we'd love to answer one of your questions in our next mailbag segment on Tuesday's show. Shoot us an email with anything coming up in your own analytical process. Our email is thefinalbar@stockcharts.com. We are on Twitter at FinalBarSCTV. Finally, on our YouTube channel, just put a comment below the video that you're watching. We would love to answer one of your questions on the air. Also, just as a reminder, in terms of scheduling, we just recorded our last 2 episodes of season 2 of Behind the Charts coming up on Monday. We have our interview with Doug Ramsey from the Luthol Group. And then next Monday, we have an interview with Larry McMillan from really an options pioneer is how I would describe him, McMillan Analysis Corporation. 2 really good interviews from some successful, technically oriented investors and traders. So make sure you check that out. Before we get to the mailbag, I did want to take just a brief moment. We actually had a passing of a technical and someone in the technical analysis community. I wanted to share with you Jim Forte, who is an active board member of the TSAA. That's the longest running technical analysis professional organization in the US, based in San Francisco. He just passed away this week. Jim was a Wyckofian. He taught at Golden Gate University with people like Bruce Frazier, Ramon Bogomazov, both of which have been on Stock Charts TV regularly and are frequent contributors, and also the late Hank Pruden, who is a pioneer on technical analysis education. Jim wrote an article for the MTA Journal back in 1994 called Anatomy of a Trading Range, which taught me, I think that was my first introduction to Wyckoff analysis, which is a great framework for understanding market dynamics. So if you did not know Jim, you probably have seen his work through people like Bruce Frazier and Ramon Bogomazov and others who have continued to push forward Wyckofian analysis. But rest in peace, Jim. Thanks for all you did for the TA community. Let's continue on with our Final Bar mailbag. First question, quick question, a lot of respect for your work. Thank you. I recently watched a video you did. You pointed out not a great sign if the index makes new highs, but the RSI cannot get back to overbought levels. It looks like the SPY is doing that. Any thoughts? And I 100% agree with you. In our weekly wrap segment here a little bit ago, we talked about that exact phenomenon, and that's pretty much what I've noticed. What causes me pause on things like this now is because I've seen this play before, and I would say what we're seeing right now looks suspiciously like where we were in January, right? You had this consolidation phase in September, October. We had a bit of a consolidation phase February to March. The S&P broke to new all-time highs, which it did again in late March. We then continued on, and in January, we had this situation of higher highs in price and lower peaks in RSI, a bearish divergence. We pulled back a bit. So we pulled back from around 38.50, let's say, down to 3,700. That's not a bad move. But it's not a end of the day move. That's like a 5% move or so. And then we resumed and made new highs and continued where we are. So what this tells me, should I expect a 5% pullback? Absolutely. And so the way I would describe my perspective now, given this divergence, given the overbought conditions on a lot of stocks, I think a 5% move down to 4,000 makes a ton of sense. I think that's a legitimate expectation here, starting in May, starting on Monday. However, the proof is in the price. Until we break below 41.20, the short-term trend remains positive. But nice catch on the bearish divergence, and I totally agree. Next question. I was impressed by Google and Visa earnings, me as well, but CROX and UPS did make a move following better earnings than expected and gapped up. Wanted to know your take as to if these stocks will fall or the moving averages will go up on these two stocks. Have a great week. Let's look at them. Let's see. First was, Visa, Google, you mentioned CROX. Right. So, it's interesting. There are a couple stocks like this. This reminds me of, RH, I want to say. No, this is not the one I was thinking of. I forgot what other stock I was just looking at a little bit ago. It looked a lot like the chart of CROX. Might have been UPS, but basically you have this trend that was sideways, sort of a basing pattern here, broke above 85, gapped higher, and then I like to move higher from there. We're overbought right now. And again, that's not something to be totally worried about, because you can see that this stock has spent a lot of time overbought in the last 6 months. As I've said, overbought means up a lot. That on its own does not mean that the long-term trend is messed up. What it could mean is that you're in for a bit of a pullback, maybe down to the 50-day moving average. The problem for something like CROX is the 50-day moving average is about 20% below where we're at right now. That would be a painful drawdown. But again, given the gap that you've had, given the move that you had, that's still a reasonable technical move, and the uptrend would be okay. So overall, I think it's a good chart. I like the long-term trend there. UPS as well. It's a really, really good chart. And what I like about this one is you had this base around 175. That was the resistance there in October. Again, in December, you sort of failed as you tried to get above it there in 175. Here in April, and then now have gapped above it. So what's great is you have this clear support level around 175. That's the pullback. Again, that's about, 15% below where we're at or so. A little bit of a pullback, not horrible, but something to potentially look for. But overall, I think the trend is pretty strong, and I like stocks like that have a breakout of a base. I would never feel that bad about being in names like that, regardless of what's going on, and just make sure you update your stops and think about your risk. Next question. We talked about RRGs this week, and this question came as a result of that. The 28-day tail on the daily RRG hopefully fits what's happening better than the weekly RRG. It's always confusing to me when the weekly and daily RRGs tell the opposite story. It's a really good point. And then when the word on when the data would be updated would be helpful. And then you talked about just when is the data updated? So, totally fair questions. And what you basically said was this. I like, having a much longer tail, like doing this and seeing how, when you bump up the, come on, I can't get the tail to update. There we go. As you bump up the tail, you can see how you get the trajectory. So here's the thing. I am not a huge fan of that. I actually like looking at the RRGs like this, to be honest with you. And I like putting it in motion. That's what I like to do with the RRG. Because remember, if you think about what the tails are there to do, they're assuming that you don't have the luxury of putting this in motion. So you just want to start right now and just look at where it's come from. And that's really how Julius de Kempener, who created this, likes to do it. I actually like to make the tail. What I've usually done, as I've used this for many, many years, I usually do like a 1-bar tail on the weekly or the daily, and I put it in motion. And as long as you can do that, as long as you have the ability to do it in motion and think about it, that's when you're really getting the dynamics. That is when on the short term, you can see this rotation higher on consumer discretionary and technology. Look how that rotates to the upper right, and then it rotates lower. That's the rotation now in the weekly quadrant. The tail might tell me that, but seeing it actually happen is the way that I actually like doing it. So what you make the tails, how you use the motion, is just ways that you can get your head around what's happening there. Now, I often look at the weekly and then the daily, and just like I would look at a weekly and a daily chart of the S&P, one of them tells me the long-term trend, One of them tells me the short-term and tactical trend. They're two different time frames for me. So one of them is giving me the big picture sort of sector rotation, asset allocation view. That's the weekly RRG. For me, the daily RRG is all about tactical entry and exit points. What's starting to improve that may not be reflected on the weekly one yet. Just like on the daily chart, you'll see a bounce on the daily chart that the weekly chart doesn't register yet. It's also something might be going, but then you wait for the weekly chart to confirm what you've seen in the short-term time frame. So certainly add some complexity to do more than one. If doing the daily one and doing a longer tail helps you understand sector rotation for your time frame that you're working on, then I think that's a great way to use it. Again, for me, my preference is do a short tail and put it in motion. I would argue that's the best thing to do. Next question, would you mind sending me the syntax you used in yesterday's show to identify stocks in new swing highs or lows? I will definitely do that to the person that wrote. If you're curious, let's see, scans, new swing highs. I run this on ETFs and on stocks multiple times a week. And this is it. It is, I use the simple version of the scanning engine. I don't like making scans that are super particular. I like general scans that give me a list of stocks to review visually. That's kind of my process. So what I basically did, the key argument is this line right here, which says daily close is greater than yesterday's daily max 65 days, and I'm using the daily closing data. So what I'm saying is on a closing basis, today is higher than yesterday's max for the last month, 3 months, right? Last 65 trading days. And then I have things like a market cap is above 10 billion, stuff like that. I will send you this all of this text, and you're welcome to do it. But that is really the essence of a lot of the scans I do, is just doing max and mins, 13-week, 52-week, and kind of doing it that way. Final question that I really have to wrap here. In this chart, and you share the chart right here, I'm wondering why I see a big uptick in a stock and then there's a straight sideways line. What would cause a stock to trade exactly at that level when things like PPO and accumulation distribution were dropping? So this, I looked at this ahead of time when you sent it. It's a really good question. This is actually what a buyout looks like technically, right? On a chart. What happened is this company was bought out, and I looked it up earlier. It's Talend, and it was bought up by Thoma Bravo. And again, I don't know those companies, so I can't really speak with any understanding of the logistics of that corporate action. But I would tell you, when a stock jumps and then settles in, that's when there's a buyout. You've kind of settled in on a price, and then it's more of an academic thing. It's just until it gets delisted, until the M&A activity is completed. These PPOs and things are relatively useless at this point, because what it's doing is it's basing on the little movements, and it's just as it's hovering around that, the range is so narrow that little movements kind of magnify it, and all it's doing is it's signaling a settling in. It's going to get closer and closer to zero and then kind of crap out there. So overall, a big jump, and then you see it flatten. That means it was bought out or merged or some sort of thing, and that's what happened with this particular stock. Great questions, everyone. Thanks so much for sending them in. As always, we need to wrap the show. Go to the 3 and 3. 3 charts in 3 minutes. Here we go. Chart number 1 is the chart of lumber. If you get that nervous about stocks, if you feel like things aren't great, particularly home builders, this chart should make you feel not too bad. The chart of lumber has been pretty good, and it's continued to go to the upside. You've seen higher highs and higher lows. This speaks to overall strength, but particularly for home builders, it shows for demand for lumber. Chart number 2 is the FXI, the China ETF. What concerns me about the chart of the FXI, to be totally honest, is what concerns me with the chart of the ARK Innovation Fund. And a hat tip to Arthur Hill, my fellow StockCharts contributor for highlighting this this week. It makes a great point. You've had a sell-off in both of these and then a consolidation phase. If these break down, and arguably the FXI is just starting to do that today, but if it gets a little bit lower, that's going to be below the 200-day moving average for the first time really since the second quarter of 2020. That's a very distributive pattern. It measures much lower, and it speaks to a lot of weakness in a market that had been a high-flying market 6 months ago. Finally, the strength in real estate, the XLRE. When I'm looking at stocks screening from the bottom up and looking for opportunities, when I'm looking at the S&P 500 names and seeing what charts are attractive, something like the real estate sector, pretty decent. And it makes me think of my conversations with David Auerbach from the Daily REIT Beat. He always brings some REIT ideas with him. And I'm often comment that real estate is a sector people love to just not think about. It's been one of the better performers. The relative strength has been improving for the most part in 2021. The index is making new highs. Charts like SPG and others and the real estate sector may deserve your attention if you've not focused on that sector at all. Folks, that is a wrap for this show and for the week on the Final Bar. Thanks so much for joining us every weekday after the close. As a reminder, go to stockchartstv.com, set up a free account. You can see all of our content for this show and all the others. Our great hosts, our great guests, and all of their insights for free. Just use your email. We're also on all the app stores. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.